Good evening and welcome to tonight's live webinar where we look at ASX investments opportunities in review for the 27th of July. Any individual reading or listening should discuss with their financial planner or advisor the merits of any recommendation or offer presented in this material for their own specific circumstances, and realise that not all investments are appropriate for every individual. Investor Signals provides a broking account service where we work in partnership with you to operate your broking account. We have access to a variety of model portfolios across the ASX Top 20, 50, 100, the US S&P 100. We have our ASX and US high conviction models which pick up the ideas expressed on these recordings and on the daily blog. We also operate an independent portfolio where we can work in partnership with you to execute ideas that we jointly agree on and utilise derivatives to enhance the portfolio return. So if you'd like to know more about the Investor Signals broking account, please contact me on 1300 614 002. The technology that I'm using tonight is the Investor Signals member area. You can subscribe to the technology for $1,320 for 1 year's access. And if you'd like to know more information, call on the number on screen, or if you'd like to set up a free trial, visit our website and select the free trial link. Moving straight into a graph of the Nasdaq this evening, and the point of interest here is that we've seen the Nasdaq break below the 10-day moving average, and as I've discussed in the past, that on its own is not a reason to be concerned or to be particularly short the market. But given the backdrop where we have, I think, a gap between valuations and where the reality of earnings are likely to be. We know S&P earnings consensus is for roughly a 40% fall this quarter, and we're just starting to see the numbers come through, and I think we've got every reason to believe that they'll average be down somewhere around that 40 to 50% mark. But where the question mark remains is, what does the recovery rate look like from this sort of depressed or these lower levels of earnings? Can we actually accelerate back to where we started from and therefore justify the valuations? There's some risks around that, and I think for that reason it just makes sense to be cautious. So if we take a closer look at what's happening here on the Nasdaq, it's under sell conditions, and we're now seeing the index roll over, and we're seeing a close below the average. Anytime we see it jump back above that, you want to cover your short positions, but as long as we start to see this roll over in the average and the index moving lower, you want to be having some exposure to the short side of the market. And the instruments to consider when doing that: BBUS, which is an inverse ETF. This is a short S&P 500 product, so it goes up in value when the S&P goes down. The equivalent in Australia is a BBOS. So these are double inverse products, meaning that if the market goes down 1%, these go up 2%, and vice versa. So the BBOS is the inverse ETF over the XJO. So again, to explain that, if the XJO goes down by 1%, this instrument will go up by 2%. So it's a way of profiting from the XJO falling. And if you're not looking for something that's got a multiplier factor like the two we just looked at then, the bear product is simply 1 time. So if the XJO falls 1%, this will go up by 1%. So a couple of ways there to start thinking about profiting from the short side of the market. One of the other ones to consider is being short the Aussie dollar. Now, one of the surprises, I think, within the recent market volatility, which has started to pick up, is you haven't seen sort of the US safe haven currency trade. In fact, it's been quite the opposite. You've seen money flow out of US into euros, divesting risk out of US equity, spreading it into the European equity markets, has helped to support the euro dollar. But there will be a point where that traditional US dollar safe haven trade comes back into play. So just keep that in the back of your mind if you sort of follow currencies, or if you're looking at risk off trades in the market. There will likely be a point where the US dollar rallies the euro runs into resistance, you're probably getting into an area of a bit of a short squeeze on the euro at the moment, which is pushing it higher. US dollar lower, which is helping to keep the Aussie dollar elevated up above or near 71 cents. So keep an eye on this ETF, the Yank. But the most successful, if you like, risk-off trade in the market has clearly been gold. So this is the Gdx Index, which is global gold miners. It has been under algorithm buy conditions for the last few years, and that's a reference to these green boxes here at the bottom of the screen. The most recent signal was there at $45. The ETF's now pushing $60. Our preference has been to play the gold miners direct through Newcrest and Northern Star and Golden Roads, and we'll have a look at some of those as we toggle through the charts tonight. The XJO, we think this is up near resistance where it is at the moment. We think the major banks have got some headwinds still to work their way through over the second half of this year, and resources are fairly close to full value where they are at the moment. The bounce back at the market's captured really a fair bit of potential forward growth. A fair bit of good news is already priced in, so the risks to the market are that Nasdaq rolls over. A test in the US is going to be where on Thursday night, where you see Amazon, Apple and Alphabet all report their earnings, and that's really going to set the tone as for whether the Nasdaq can reverse and trade back higher, or whether really the highs are in for this recovery. On that note, let's have a quick look through tonight. What I wanted to do is just go through the top 50 stocks, and then I'll come back and have a look at the recent stocks that we've posted on the blog. So go to watch list, come down here, select top 50. Start by getting the percentage gainers to the top. Organize the list so we're going through the stocks that are all under buy conditions first, and then as we toggle through these, we're going to get to a point where they switch from companies that are under buy into companies that are under sell. I'll highlight that as I go through when that switch occurs, and as we move through these cells, we'll start to identify 2 or 3 key names to think about on the short side of the market. At Newcrest, this has been it's a holding in our top 20, 50 and 100 model portfolio. It's in our high conviction portfolios, and gold's continued to perform well, pushing over 1900 an ounce. If we have a look technically what's happened here with Newcrest, it's switched from sell conditions into buy conditions. Continue to sort of make these higher low formations through here. Now we're pushing back up to 36. Maybe the range for look, there's some risk that gold goes parabolic if equity markets actually break and move lower. The chances of that are relatively low, albeit probably increasing slightly. So I still think you want to be on the long side of gold somewhere in your portfolio at the moment. So whether that's through Newcrest, GDX or Northern Star as the main ones. Sydney Airport's high risk, but maybe developing support down here at $5. The market is forward looking, so do we get into sort of middle of next year and the outlook start to improve a little bit for Sydney Airports? So just highlight there that high risk, but some support there at around that 525 to 550 level. I reckon this has been one of our preferred trading opportunities in the market. It is a stock in the top 50 model portfolio. Our simple philosophy or thesis here has been that the company moved early to shore up its balance sheet. The mining industries remain buoyant. At around $16, we saw the buying interest starting to tick up, the short-term indicators turning positive. Now the stock's pushing up towards our target. Maybe it can trade 18.50, and then we'll reassess whether we want to lock in those gains. For longer-term investors, they may choose to stick with that position, but we'll certainly review it from a trading perspective, and I'll update you on the blog. That's performing well, up about 10% from the recent entry level there. QBE, they're cautious on the insurers, and we've seen the impact on Insurance Australia Group. So not doing there in QBE, but it is in the model portfolio. APA starting to warm back towards APA again on, when you're on a relative basis. When you look at risk reward in other areas of the market, APA starts to look attractive. Support at $11, as I highlighted in the last week or so. The company has gone ex-dividend, so you're waiting a while for the next dividend payment, obviously 6 months, but fair value coming into that next dividend may very well see APA push back up between that $11.50 to $12 range, and we'll review that closer when we see the upcoming earnings come through. Fortescue switch from sell conditions to buy conditions there at around $7, continuing to make higher highs and higher lows, so that stays in the model portfolio. The ASX is in the top 50 model also. It's under algorithm buy conditions, further supported by a short-term pivot point here that looks positive. From a fundamental standpoint, the stock is a little expensive and earnings growth is slowing. So I've highlighted that in a weak market, if we saw it back at around that 76 level and another algorithm buy signal, you'd certainly be wanting to add ASX into your portfolio. High quality business. Westpac, so all the Aussie banks we're avoiding at the moment and more on the short side, so I'll talk about that as we get to CBA. CSL, not very often you see this stock correct over 20%, so it's come down from 350 to 275. It's getting into that second part of the range there that we highlighted is a possibility where maybe it breaks in a soft market and retests sort of that 250 level. We just don't know what the upcoming earnings results going to look like, but we do know from long-term trends, CSL being an industry leader and innovator, balance sheet capacity to acquire competitors, the likelihood of it continuing to deliver double-digit earnings growth over the next 10 years is high. So it's a stock that you want to keep an eye on, and if you don't already hold it in your portfolio, add it on these dips. If you do already hold it, maybe it's an opportunity to think about just buying call options and running a short-term trade, especially if we see the stock dip down closer to that 250 level. And I'll continue to update you on the blog regarding our strategy around CSL. Sonic Healthcare, terrific business, growing earnings, probably somewhere around that 5 to 6%. Getting expensive up where it is at the moment. We think we'll see a sell-off in this over the coming months, and it has made a higher high. We'd expect to see a new algorithm buy signal on sort of pull back into the back half of this year, and so we'll keep an eye on that. Some of these high quality names that are not in the model at the moment, I think over the next 6 months you're going to see that change. You'll see a pullback in them and a large number of them added back into the model portfolio. Dexus not doing there at the moment. Santos supported around $5. This has been one of our preferred energy names. It's held up slightly better when you think about, say, Origin or Woodside's held up okay, but hasn't done too much to the upside. So I think Santos has been the right choice within the energy space. Support there at around $5. Ramsay Healthcare, it's worth pausing and having to think about this one and adding it to your list. $60, between sort of $60 and say $63 is the entry level. I think we look back in 6 or 12 months' time, and at or near this point represents a good long-term entry for Ramsay. It is a low-growth business and offering just over a 2% dividend yield. Brambles, again, pause, write this one down. About 8 weeks ago, Brambles came out with earnings guidance, reiterated their expectations for earnings to grow at around 5 to 6%. They were one of the few companies that maintained earnings guidance, and that clearly was taken as a positive sign. Since then, we've seen the price fall away from that $11.50 down to $10.50. What the recent weakness has been is with a number of or investment banks have sounded warning around their price targets for Brambles, and they were relatively high in the first place, up around $13, $14. So to see those price targets lowered a little is probably not out of line with where fair valuation is. Fair valuation for Brambles, even in a strong market, was really only around that $12 level. So this is a buy on the dip opportunity. We do expect Brambles to find buying support. So, mate, whether it's 10.50 or a little bit lower at 10.20, keep an eye on these short-term momentum indicators. I think there's a buying opportunity coming up here in Brambles. James Hardie. So now what's happened is we've switched from stocks under buy conditions into stocks under sell, meaning the most recent signal is the red box up the top rather than the green at the bottom. So in the case of James Hardie, it's not in the model portfolio at the moment, and thinking that it develops resistance around that $30 level. South 32, we're not doing anything here at the moment, but as I've highlighted on the blog, there is some takeover speculation. You're starting to see a little bit of money flow into South 32 purely on a valuation basis, but earnings are going to be down substantially, about 40%. On the same time last year, and that's just a reflection of lower commodity prices within the commodities that they obviously mine. Vicinity centres, cautious here, lower low, lower high, not doing anything there. Goodman Group, terrific business, just getting a bit expensive and maybe worth taking profit up where it is at the moment. If we were to see a pullback in the back half of this year, we'll see that added back into the model portfolio, and we'd be quite happy to hold Goodman Group again. Aristocrat Leisure, cautious here, resistance at around this $26 level, and we want to take a much closer look at the upcoming earnings result. Transurban, tempting to buy this on the dip here at around this $13, but we're just waiting to see if we see another leg lower, a break below 13, anywhere around that 12.80, 12.90. We'd be happy to pick it up, even though it's under sell conditions at the moment. Stockland's under sell conditions, so resistance there at around $4, moving lower, and a bit hard to sort of get the confidence to add Stockland in at the moment. Centre Group under sell conditions, Qantas under sell conditions, so again referencing the signals here and the stock moving lower following that. Wesfarmers, so this is one on the short side just to stop and think about. If we see that Nasdaq break below the average and sentiment in global markets weaken, then Wesfarmers kind of priced to perfection where it is at the moment. So not really not too heavy on the short side of this, but just keep an eye on it up there at around 47. Starts to look a bit expensive. Mirvac, not doing there at the moment. Woolworths. So we've owned Woolworths and Coles throughout this period as a defensive income stream to portfolios. They're back up at full value, so selling call options over them, you're turning a 3-4% yield into 8 to 10% yield by selling the covered calls in between the dividend streams. So if you'd like to know more about that covered call strategy, call me in the office on that 1300 614 002 number, and happy to explain more and work through some pricing with you on those covered call strategies. Telstra. So interesting here that we've still got the lower low, lower high pattern. It rebounded, shifted back to sell conditions there at around 350. It's moving lower. The big fundamental story here with Telstra is obviously the separation of Infrastructure Co. in 12 or 18 months' time. Has the potential to unlock $2 plus of value per share, if it proceeds. So buying Telstra on this sell-off, it's hard to see, even from a fundamental standpoint, it coming back down and retesting these lows. So maybe watch this short-term momentum indicator, and if you start to see this turn higher, you could think about buying Telstra on this pullback. Now again, wouldn't normally be buying stocks that are under sell conditions. There's not many stocks in the portfolio at the moment, given how few stocks are showing those buy signals at the moment. BHP under sell signals after rallying back from 25 back to 37, so seeing that up against resistance. Again, we're happy continuing to hold BHP, but selling covered calls or just trimming the level of exposure in the portfolio makes sense. Coles, again, selling covered calls. We don't think the downside risk substantial, but at around $18, we think Coles is full value. So again, rather than just holding it and collecting a 4% dividend yield, sell the covered calls, and you still allowing for some capital growth, but you're turning that into almost a 10% yielding stock. Computershare up against resistance at 14, cautious on this name, and we want to take a much closer look at the upcoming earnings result. Ampol, which is the old Caltex business, resistance up at $30, and that's just really a reversion to the mean. Fair value for Ampol is around that $27-30. This was the anomaly from the takeover premium, so we think that just consolidates and moves sideways where it is at the moment. Macquarie, resistance up here at around 130. We'd expect the trading revenue to be boosted by the March volatility, but the underlying business probably is facing some slower conditions, so it might be a case of the short-term results look okay, but maybe the forward guidance doesn't quite meet market expectations. So looking for that to run into resistance at around that 130 level. Amcor had slow levels of growth coming into this COVID period. Underlying business was only growing 1 to 3%. There is the cost synergies from the Bemis acquisition that underpin, so we don't think the downside risks are great here for Amcor, but we would like to see it pull back and be a buyer of that on a dip rather than continue to chase it. Origin Energy, happy to own this even though it's under sell conditions. Around this 570 should be good support. The company's done a great job of paying down debt. Underlying earnings growth supports a 4% dividend yield, so we don't think the risks to the downside are significant there in Origin. Rio Tinto, as with BHP, you can continue to hold this name, collecting the 4% dividend yield, selling covered calls over it. We don't think the upside is significant, but given sort of those risks around the backdrop in the US market, still want to be cautious as to just how much long exposure you're holding over the next month or so in the market. NAB, on the short side of NAB as we are with CBA. ANZ's under sell signals there. We can see the lower high, and the stock's continuing to sort of struggle there below those resistance levels. Not doing A2 milk. Just to comment on A2 milk, I would expect to see this shift to buy signals in the back half of this year, so we'll wait for that to be added back into the model portfolio. CBA, resistance here at around $75. They report their earnings on the 12th of August. The market's looking for earnings to be down about 10% on the same time last year, and for a 50% cut in the dividend. There's still risks with the Aussie banks that there's further capital that they need to raise later this year to shore up their balance sheet. The risks still seem fairly elevated in the context of some, the concerns around the valuations in the US market and what level of true underlying earnings there are. And that's not just an issue for the US, it's a global economic issue. GPT, cautious on the property trust there. You can see there switched the sell conditions resistance at 450, so we're not doing there at the moment. Woodside under sell conditions at 25, preference Santos over Woodside. Cochlear now under sell signals, so cautious here. Our preference is CSL over Cochlear. Ramsay Healthcare over Cochlear. So Cochlear's faster growth business, but cautious there. It does trade on a very high PE, up around 45 times earnings, so it is expensive. So not much margin for error there. Oil Search preference Santos over Oil Search. Medibank Private, cautious on the insurers, even within the healthcare space. So thinking Medibank up against resistance there near $3. Lendlease, under sell signals there at the moment. We do like the longer term fundamental story there for Lendlease. AZJ maybe back down at around 425. It has good yield support, but it is under sell conditions there at around that $5 level. Suncorp, sell conditions there at 11 within that banking space. Cautious on these names, and every reason to think Suncorp actually moves lower. Treasury Wines, resistance there at around around $12. Earnings fell short of consensus expectations, so again cautious on that, and whilst we're not on the short side of this, I'll just highlight the resistance there at around $12 and some of that sort of weak pricing activity that we've seen. AGL, reasonable dividend yield here at about 4.5%, but little in the way of earnings growth, and it is under structurally sort of this lower low, lower high pattern which continues. We had the rebound back in the algorithm sell signal there at $18, so we're not chasing anything on the long side there with AGL. Insurance Australia Group. So here's a great example of where we've seen the algorithm model work perfectly. It's tracked the rebound in the stock price up to this 650 level. We've had the sell signal, and since then we've seen the stock fall away 30%, trading $5. We saw the earnings fall more than 50% in IAG, and the company's cancelled their second half dividend, and I think that's reflective of a broader struggle globally that the insurance companies are going to have in a low interest rate environment and increasing risks around their equity book exposure. And then there we are back to Newcrest. So revisit the recording if you want to focus on sort of these buy signals. I'll just show you another way to recap what it is that we've been talking about on the blog. So click on watch list, come in here, select recent blog posts, ASX from the bottom there. That loads the last 30 days of stocks that have been tagged on the blog. Again, I like to have a look from the percentage gains to the top. Get the stocks under buy conditions. As I move through these, they'll go from buys into sells. So again, if you've set up a 30-day free trial on the Investor Signals website, which you can do that by visiting investorsignals.com, click on free trial, and you can get access to the technology that I've presented tonight. And part of that is the daily blog. So at 11 a.m. you get an email from Investor Signals which captures the analysis of the stocks that we're looking at in the market at that point in time. So what I'm about to do is just toggle through the last 30 days of stocks that have been posted on the blog. So TPG we like. The catalyst for this sell-off was an investment bank published a paper on the risks that are facing the integration for TPG. We think that they may have merit longer term, but right at the moment this 750 is a buy, back up at around 850 as a sell. So that's a short-term trade in the market. Now we've been bullish Newcrest from originally back here at around this $21 level, and pretty much every time it's made these sort of troughs within this uptrend, we've reiterated the buying opportunity in Newcrest. It is getting a little extended at the moment from that last sell-off, but given the risks there in the US market, we could see another day or two of higher prices. But the fundamentals continue to support gold moving higher. Northern Star, the same story here, bullish structure, and all these blog posts are just highlighting that as one of our preferred opportunities in the market. Sydney Airport's just highlighting support here at around $5, but clearly carries a little bit higher risk. Orica, continue to like this. You could hold the stock as long as it sits above that 10-day moving average. Hopefully we start seeing it push up to around $18 there, and you can either take profit as a short-term trade or continue to hold it longer term. Alumina, this has rallied off the 150 support level. This will be an interesting test. We've made the higher high, we've pulled back. The stock does have quite a lot of institutional support. On average, price targets up around that $2 to $2.10 range. We're not quite that bullish on it. You know, the outstanding matters, you know, with the ATO investigation or charges that have been put forward. I think, as I'd mentioned, there's about $200 million in taxes that haven't been paid, plus substantial fines. You know, the total liability could possibly exceed $700 million. In saying that, the investment banks seem to be comfortable that the company can absorb that, and they're still bullish on forward earnings growth. For me, it's a stock that if we can trade out of it up at around that 180 to 190, that, you know, so this is a bit of a test here to see whether this higher low formation holds, any break back below 150 is going to be negative, and you really need to reassess whether you want to continue to hold it. Pro Medica, so this is a fast growth company in the imaging space. They provide technology within medical imaging. About 40% of the revenue flows through to bottom line, so their margins are very good, but it does trade on a very high multiples, up at nearing 100 times earnings. We want to have a look at the upcoming earnings a lot closer, but at around this sort of pullback here, purely from a technical standpoint, high growth company, buying it on a dip, looking for support to develop within that range that I've highlighted on the screen there. AusNet Services, so defensive yield name, up at around that 180 level. We were buyers of it at lower levels, up at around 180, start to take profit. CSL, so I've highlighted this again just to revisit. If you already hold it in the portfolio, maybe think about buying covered calls, which gives you the right but not the obligation to take delivery of the shares, or effectively have limited downside risk to what you've spent on the call, but benefit in the upside. The valuation range is probably somewhere between that 240 and 270. At the moment, the stock price is below the 10-day average. These indicators still appear to be heading a little bit lower on the short-term basis, but I'll continue to update you on the blog as to those shorter-term trading opportunities there on CSL. Santos I've covered tonight. Ramsay Healthcare, we like that. Brambles, trading opportunity approaching there. Keep that on your watch list. Beach Energy, preference is Santos over that. Bega, generally the stocks that have, with increased people at home cooking, spending more time in the house, less time out at restaurants. Bega Cheeses, should probably be a beneficiary of some of these trends, and we've seen that in other global stocks that have reported already. So we'll wait and see what Bega's results look like at the moment, but just highlighting that you could see support there around that 440 level. A couple of short stocks. REA looks too expensive on an analysis, so does Seek. South 32, I covered that earlier in the recording. Aristocrat, I think maybe runs into resistance where it is at the moment, but we really want to have a closer look at the upcoming earnings for Aristocrat. Altium, not really doing too much there at the moment. Rio back up at a resistance at around that 100 level. Incitec I cover. Well, Incitec, just to revisit this, our preference is Orica over Incitec, but Incitec also moved quickly to shore up their balance sheet, so we're just keeping an eye on whether the buying interest starts to pick up there. CBA up at around that 75, looks like a short. CIMIC Group reports their results on the 30th, so we'll update you on the blog, but the fundamental story there with tidal infrastructure spending should be supportive, so we'll dig through those results closely. Treasury on the short side, and then there we are back to TPG. So thank you for listening in tonight. We've visited a handful of stocks on the buy side, and a couple of stocks on the short side as well. As the replay of the recording gets sent out, there'll be an attachment or a link to this particular sheet. And in prior weeks, we've looked at some of the US stocks. I don't have time tonight to do that, but we'll start to look at some of the performance of these US names, as we especially get through sort of a heavy week of earnings this week. So I'll cover that in next week's recording. On the ASX side of it, so TPG, so if you see that pull back, have a think about that off that 750 level. Brambles, have a think about that between that 1020 and 1050. Northern Star and Newcrest continuing to rally, but clearly you're coming in at late levels if you're not already set. CSL below 275, make sure that's on your watch list. Alumina, slightly higher risk there, but at 155 is pulling back off that recent 175 high there. Orica we continue to like, as we did at 1550. It's now pushing up maybe closer towards that $18 level. Santos Oil appears to be more in a consolidation range, but still Santos has support around $5. Newcrest recovered. Ramsay Healthcare around that $62 to $60 level. Mark that on your list. Sydney higher risk APA $11 support. PME's the Pro Medicus, which I spoke about. The ETFs we covered. Cure was a new one that was added tonight. That's an S&P Biotech ETF. If you've got the time, have a look at that on the charts, and I'll update something on the blog. And there we have some short signals. So these notes are just some rough guide there to help refresh you on stocks that have been covered in the recording. Thank you for listening in, and if you'd like to take advantage of the subscription to the member area, contact me or visit the website to start your free trial. Thank you for listening in.